If there's one thing I would beg and plead people to do, it's pay attention to the macro. 90% plus of every single deal that I got was multifamily floating rate bridge loan. Those blew up, everybody was going to get burned. And that's kind of what's happened. The GPs were like ganging up on me and making fun of me, and the audience is laughing at me for saying you have to be cautious. I get very concerned about this because I feel like people are trying to chase yield, pivot and chase yield. Why did my cash flow stop? Why am I getting capital call? Why is this getting foreclosed? Which was not in any of the business plans that they read. I am practically fully on the sidelines.
Investors and operators, welcome back to the Invest Clearly podcast. In this episode, we sit down with Jeremy Roll, a full-time LP since 2007 with over 2 decades of experience in the alternative investment space. Jeremy shares why he's currently on the sidelines, how he thinks about negative leverage and end-of-cycle dynamics, and what would need to change for him to start investing again. We talk about sponsor conservatism, yield chasing, and why he believes discipline and patience are critical during uncertain market cycles. Let's get into it.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. All right, perfect. Jeremy, thank you very much for joining me. I didn't bring this up off camera, but before we get started, I just wanted to share sort of how our relationship got started. I don't know if you remember this, but right when we launched, you had reached out to me on LinkedIn, asked for a demo of the site, provided me with some feedback. But the coolest part of that, and as it impacts this podcast, is when we got on the phone, you asked me about like doing the podcast circuit. And at the time I told you, I was like, look, I'm honestly a little nervous about doing that because I'm not doing this because I'm an expert syndicator and I'm afraid. Like if I start getting peppered with questions about waterfalls and distributions and NOI and IRR, I'm not going to be the best person to answer it. And your like quick but fair challenge question was, or what you said to me was, it'd be very disappointing if no one learned about this because you were insecure about going on podcast. It was like something like that. And I was like, whoa, like, all right. And because of that, like I went on the podcast and the growth of our user base wouldn't be what it is today if I didn't do that. So I just want to say thank you before we get started.
Oh, absolutely, yeah. And I hope I didn't word it too bad. I try not to be harsh normally, but I just love what you're doing. I think that you're trying to help everybody, and so to me, of course, you want as many people to hear about it because you want to be able to help them. So
yeah, for sure. It wasn't harsh at all. It was like it would be really disappointing if no one learned about this. I was like, all right, I have to go now. But awesome. But Jeremy, thank you again for joining us. Before we really jump into it, can you give us like a 30-second intro on your background, what you're doing today, and then we can get going?
Absolutely, yeah. So my name is Jeremy Roll. I am located in Newport Beach, California. I have been investing in the alternative space in mostly real estate syndications, but also non-real estate and other business type of opportunities, and a little bit of startups as well, since 2002. So it's been 23 years. The cash flow got me out of the corporate world back in 2007. So I've been doing this full time for about 18 years. And it's a really interesting space, a lot of challenges the past few years. I just love what you're trying to do in terms of helping people and, especially what Invest Clearly is trying to really accomplish. And I hope this podcast is helpful for as many people as possible.
Yeah, thank you. Awesome. So you are, by definition, a professional LP. Is that what you consider yourself? You do this full time?
Yeah.
Okay, awesome. And so you see more deal flow, you look at more sponsors, you've probably had more experience than the majority of the people listening to this show. What are you seeing in terms of trends, maybe among deals from 3 to 5 years ago to today? Are they getting better? Is there more of them? Is there less of them? What are you seeing?
Yeah, boy, there's been a big change. Without trying to give you too long of an answer, what was going on, let's say in 2020 to 22, which is roughly 3 to 5 years ago, was a lot of money printing, a lot of capital chasing deals, a lot of what I would call like end of cycle, very high pricing, and a lot of financial engineering by sponsors to back into, let's say, 15% plus IRR targets to attract investors. And in order to do so, there was a lot of financial engineering in the capital stack. And what I mean by that is that there were a lot of deals, almost all the deals had a preferred return layer because they had to make sure they can raise enough money. Most of the deals, especially in apartments, were floating rate bridge loan deals. That was not by mistake. That was because in order for them to get back into the correct yields that investors were trying to find and that would interest them, they had no choice but to do that because they were paying so much for the assets. And then when we had interest rates start to go up back in March of 2022, 22 from the Fed, That changed everything, and that basically does what it typically does to real estate, which is interest rates go up, and that really puts a brake on pricing. It puts a brake on investors questioning where the market's going to go. So deal flow has slowed probably, if I had to guess, 75 to 90, probably more like 80 to 90%. It's been a tremendous change. Investors have had a lot of challenges if they went into those floating rate bridge loan deals. So I would say the biggest change, honestly, because end of cycle, you're going to get a reduction in deal flow, and that's normal. What happened this cycle, which I kept saying for a while, and it really bothers me, is that back in 2020 to 22 as an LP, 90% plus of every single deal that I got across all asset classes in real estate was multifamily floating rate bridge loan. So if you were going to invest in anything, you almost had to invest in that if you were like hell bent on investing. I didn't invest in any of those, but if you wanted to invest in anything, you almost had no choice. And that created such a concentration risk for investors, meaning that if those blew up, everybody was going to get burned. And that's kind of what's happened on the LP side. So now what we're seeing is a big exit of LPs, or at least a lot of LPs, certainly at the very least questioning, why aren't those deals performing to projections? Why did my cash flow stop? Why am I getting capital call? Why is this getting foreclosed?
Yeah.
Which was not in any of the business plans that they read. So there's just a huge, it's almost like going from one end of the spectrum to the other in the past 3 to 5 years. Sorry for the long answer.
No, I 100% agree, and that's the narrative we're hearing as well. Like you hear a lot of these people who talk about dry powder being on the sidelines, but there's not a lot of narrative around of like there are people that are being pulled out of this market based on what just happened, unfortunately. So when you think about all of that floating rate debt, the deal flow being down 80 to 90%, maybe you holding off on making allocations then, what does your strategy look like now based on all of those things?
Yeah, I'm very much on the sidelines. If I can give you the past 5 years, 20 to 2022, I was very cautious. 23, I was extremely cautious. 24 and 25, I am practically fully on the sidelines. And so unless there's some really unique, Layla on the podcast with you called it unicorn, unless there's some really unique odd situation, I am on the sidelines. And for me, the number two reasons, one is I want to see if we're going to have what I call an end of cycle reset, which would potentially be started by a recession. But the other is negative leverage, which we've had for years now, and which to me is like, if you ask me my one guiding light as to like, how do you know when to jump back in? It's positive leverage. And we continue to have negative leverage in a lot of deals that I see. The few that I see with positive leverage, there's some other additional layer of risk. It could be a tertiary market, it could be a very old asset. It could be a very high risk deal, like in terms of highly value add, which I don't personally look at. I look at more stabilized cash flowing deals. So I'm very, very much on the sidelines. And one more data point, because I really follow macroeconomics closely, which is, we had an inverted yield curve, the yield curve uninverted back, I believe, in October of 2024. You would almost always have a recession within 1 year after that, and very commonly within 6 months after that. We're now at that 6 to 9 month time frame that we're recording this. And so if you look at probabilities based on history, we have a high probability of recession coming up by the end of the year. I'm not saying it's going to happen for sure, but I have to work off probabilities to try to protect myself, especially in illiquid investments like this. So that's why I'm very much on the sideline, just waiting to see what happens.
Yeah, that's so interesting. So this is more of a question for me and maybe the audience, but you've been sidelined for the past few years. Cautious, you said. You're sidelined now. You do this full time. How do you remain disciplined, and not succumb to FOMO?
Yeah. So that's hard. And I want to be clear, it's not like I've made no investments in the last 3 to 5 years. That's totally not true. It's just a much lower volume than I typically do and would like to do, right? So let me just rewind back to 2005, 2008, which I know was a long time ago. 2005, 2008, I was much younger, and I would go to dinner parties with friends, and I'd say, there's going to be a housing crash. When I was saying this in 2005, people thought I was crazy. I went through 3 years or 4 years of people thinking I was crazy. Okay, that is very, very difficult to go through, and I feel like I actually went through the same thing. And I have many stories of this. I mean, I have stories sometimes I'm, let's say, on a panel on a stage at a conference. In 2020 to 2022, I had multiple times I was on a stage, me and 2 GPs and someone who was moderating and the GPs were ganging up on me and making fun of me, and the audience is laughing at me for saying that you have to be cautious, blah, blah, blah. And it turned out to be correct, but it's just because it's end of cycle timing. It's not like any genius thought. It's just like we've been in a cycle for so long, eventually something's going to give. So it's extremely frustrating. It's very, very difficult. You go through stages of like almost like mourning or grief. And I'm not joking, because we're talking about years here, not like months, you know. What I would say though is that I have a lot of patience, I have a lot of persistence, and it's just part of my personality. And honestly, if you don't have that and you're more of an emotional investor, it could be very dangerous. And so what I try to do is figure out, okay, what makes sense at this timing? So let me give you an example. This isn't necessarily real estate or cash flow related, but startups, for example, which is like 1% of what I do and not a focus at all. You know, if you look at the past cycles, once interest rates went up, there was a crash in 2022 of startup valuations. There was a complete reset. There was major layoffs in tech in 22 and 23. Now you have the formula of cheaper labor, a lot of very good labor available, and valuation resets complete. So I've actually invested in a couple of venture funds last year. There are always opportunities at all timing. In fact, this is one of the craziest things I'll say this year, which is I just took a position on Bitcoin maybe a month or two ago. And that's because I believe we have just the last leg up. And I'm just normally I wouldn't be looking at that at all, but it's like, okay, what can make sense at this timing? I'm doing that. That's obviously very speculative, but I think there's a high probability of that coming out. So as you can see, it's not the traditional stuff that I'm doing, but I think I'm doing the right things at the right timing.
Sure. Yeah, you have an interesting portfolio. I feel like most real estate investors are extremely loyal to real estate, and like that's it. Like I'm starting to see a lot of these niche assets that come with operations. Like the O&G obviously has been around forever, but I just spoke with someone who has marinas or senior living is making a comeback. I'm seeing a shift to that on the demand for like listing funds, but it's seeming to see like almost crypto is sacrilegious to real estate investors to a certain degree. So
yeah, and it's not normally it's actually, I don't want to be doing it, to be honest. I'd rather put my money into more stabilized, predictable cash flow, but right now that is too expensive. So, you know, I'm kind of in the same mindset as Warren Buffett. Warren Buffett has all this cash on the sidelines because multiples are too high. That's the reason, right? To me, you're paying too high a multiple for the income on real estate, and therefore the valuation is too high and the cash flow is too low. It's the exact same reasoning. But I am doing my best to just, figure out what may make sense at a certain time. I want to make a very important comment about what you just said, though. So you were talking about people pivoting away from real estate and looking at other assets, right? And that's been happening since 2022. Once interest rates went up and multifamily got hit, it was like anything but multifamily. And then, the past few years, there's been almost like a string of like people have checked private credit, then this, then that. Yeah. I get very concerned about this because I feel like people are trying to chase yield, pivot and chase yield. And let me tell you that I'm very, very concerned about it, because if you pivot to oil and gas, and I don't mean to pick on oil and gas, but let's say you pivoted to oil and gas in 22 or 24 because you were away from real estate, you wanted some yield. The problem with oil and gas is that if we do have an end of cycle reset, that's one of the worst assets to have in it, because in a recession, oil and gas plummets, right? And so the concept of trying to find something different makes a lot of sense, but there are times in the cycle at which almost nothing makes sense. So let me give you an example. If we rewind back to 2007, and I said, I'm pivoting to oil and gas, it's January 2007, or I'm pivoting, it doesn't even matter what it is. I'm pivoting to private credit. I'm pivoting to what it is. There's, I think, a much higher risk associated because of cycle timing with anything you're pivoting into that you're trying to get away from that I think a lot of people are giving credence to right now. So if you're going to look at pivoting, that could be okay, because there's some stuff that does actually really well in recessions, but make sure you fully understand where we are in the cycle and have your own opinion about it and how that overlays into what you're considering pivoting into. Because trust me when I tell you, there are certain points in the cycle where I know you want to get cash flow, I want to get cash flow, but it's possible that almost nothing makes sense at certain times. Just make sure you have an opinion on that. Doesn't matter if it's different than mine.
Sure. And when you think about the pivot and maybe these like better than recession, like assets to focus on in a recession, are you pivoting lightly at all into those? Like, for example, I don't know what those are in your mind, but is there any sort of like, let me check these out for you right now?
Well, here's the problem. The problem for me is that even those assets are overpriced right now because people are paying too high of a multiple on them right now, because asset prices are still, we just hit record all-time highs in the S&P 500 and the NASDAQ this week, okay? So we have a valuation problem, in my opinion, still, because I think there's a high probability of a recession coming up based off of some of the data I shared with you earlier. And so to me, it's almost inconsequential. I just can't afford to overpay for something. because my money is locked in. These are very illiquid assets in this space. I can't just wake up and sell easily. And so I have to make sure I'm getting it at the right valuation. And my opinion or my approach is to wait, go into treasuries and wait for the right valuation to reduce a lot of the risk in the future, 5-10 years down the road, that to try and get a little extra cash flow today, which frankly may or may not be the better choice. That's just the one that I take.
Yeah, and I mean, I engage with quite a few LPs, and I don't think I know many of them have not brought up macroeconomic factors in their decision making. It's all about deal due diligence. It's all about sponsor due diligence. This is the first time I've really heard of all of the influencing factors that potentially aren't being considered.
Yeah, I cannot stress that enough, because if you review a business plan in front of you today, it will technically make sense in the way that it's been marketed, because otherwise the sponsor wouldn't be buying it, right? And so they're going to try to make it make sense for as much as possible. But the problem is that if you overlay that onto a 5 or 10 year timeline, it becomes a lot more questionable, and then you have to decide whether or not it makes sense for yourself. I'm not even referring necessarily to the short term. Is there going to be a recession? I'm talking about if you go into an office building today, and I'm sorry, I'm just choosing office because a lot of people understand the example. I'm not trying to pick on it. What will the demand be for that office building in 10 years from now if you're getting a 10-year fixed rate loan? Hard to say, right?
Yeah.
But if you go into a multifamily building that's in a strong area with a lot of projected population growth and a strong job market with projected job growth, right? Then what's the demand for that multifamily building going to be in 10 years? I think the more obvious answer is the multifamily building has more predictable demand in 10 years than the office building on average, right? And so you have to take that into account. And that's potentially due to macro factors and even societal, differences and changes going on over time. So it's not just macro, it's a lot of very high level stuff that goes into this. And if there's one thing I would beg and plead people to do, it's pay attention to the macro. Because I think if people paid attention to the macro, they would have been a lot more scared about the floating rate loans, because we were already in a record long economic cycle as of 2020 by that time. So I don't care if you thought there was going to be a recession in 21, 22, 23, 24, whatever it is, but unless you believe cycles were over and we're never going to have a recession again, you have to be extra cautious at that point, just purely based on the fact we are in a record long cycle already. And now we're even in a longer record long cycle, right?
Sure.
That's why you really need to pay attention to these things.
Sure.
This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster.
So when you think about like our audience, it's a mix of experience and newbie investors. When you really hone in on pay attention to the macro factors, you touched on a couple. Are there any other critical signals that you would tell people to look for that impact whether or not a deal works in the future?
Yeah, well, a deal works in the future?
Well, meaning, does this deal pencil based on the external factors?
Yeah, that's really going to depend on the deal. So the asset type, the location, so many factors that how big is it, what other supply is coming on. I mean, there's like a laundry list, right? But what I was referring to before is just the general, like, are the tailwinds with you in general, or are there headwinds for you based on the global macro factors of what's happening in the global economy? Because the reality is that most or every asset class is impacted in a negative way if there is a recession. So do you want to, you have to assess what you think the probability of recession is, when it could happen, and do you want to take that risk or not based on your own opinion? But it's so important that you formulate your own opinion about that topic specifically. It's just to your point, I think a lot of people don't think about it.
Yeah, I mean, everything you're saying, it's like almost like eye-opening to me. Is like, why haven't I heard this from people more? And so it's encouraging and discouraging at the same time. But so we talked about the macro side of things. We talked about your position over the past few years, what you're looking for, looking forward. Invest Clearly is all based on like trust, right? Like validating and, cutting through influence. When you think about shifting from deal to sponsor, you find a deal that pencil, it is potentially the quote unquote unicorn. It makes sense now. How do you like become trustworthy of the operator that's running the deal? What do you look for? What does that look like for you?
Yeah. So what I will say, because we can spend a lot of time on this topic, but what I'll say high level is I'm trying to find someone who is conservative, like my personality, who creates conservative projections, is looking to underpromise and overdeliver to create long-term relationships with investors. And I'm trying to avoid someone who is very aggressive in their assumptions, is trying to create nice marketing materials with really big numbers to attract investors, but they have such a marketing machine that they don't really care if they overperform because they're going to continue to use that marketing machine to find other investors anyway. So that's like the easiest way to summarize it, right?
Yeah.
And so you really need to kind of read between the lines to figure this out. So you can ask certain questions to the sponsor directly to see how conservative they are. You can read the tone of even, when they're talking about their assumptions in their summaries. How's the wording done to see if they're really conservative or not. You can ask them questions and listen to their answers in terms of their wording. Again, will tell you how conservative they are. And I'll tell you one very big complication right now in assessing and evaluating sponsors, unfortunately, is are they dealing with other distress, and how much of a impact will that have on them to, their ability to operate the property you're about to invest in without any distraction. That's a very big challenge right now. Because I would argue even one piece of very big distress can really distract them. So I think you have to add in the layer of really peeling back. What did this sponsor do the past few years? And are they dealing with floating rate loans? Are they dealing with loans that are coming due soon? Are they dealing with some other challenge, either because of type of asset or location or whatever it is, that increases the risk for you without increasing the potential reward?
For sure. Okay, that's fantastic. Thank you. And when you think about how disciplined you are, analytical, and you have these sort of, I would say maybe benchmarks or thresholds that you think about when you're evaluating these guys, have you ever pushed through a red flag and then it turned out to be a poor decision and reflected on that? And if so, like, what did that whole scenario look like?
Yeah, that's a good question because, God, I've invested in like over 200 deals. So
Yeah.
I'm just trying to think if one comes off to mind very quickly. What I would tell you is that in retrospect, I've had more learnings about pushing through a red flag, whether it's like more of a tertiary market, for example, that I was like, okay, but that's outweighed by X and Y, or the demand still looks pretty predictable, that then some other factor you didn't consider or some change in the economy caused a bigger challenge for that market. And I've kind of learned the hard lesson that way. But I would say that it's much more rare that I push through a red flag and learned that, oh, I should push through red flags. If anything, I've learned that I should really narrow my box, I call it, or what I'm trying to filter through, to as small of a box as possible, to both reduce the possibility that I'll push through red flags or like look at distractions and go with those that I shouldn't be, right? And increase the probability that I'm not wasting time looking at something I shouldn't be looking at all,
Sure.
just with my own personality.
Sure. Yeah, that's great. Oh, and you mentioned, Layla mentioning the unicorn earlier in the show, and that was in response to our conversation about deal flow. What does your deal flow look like right now? How many deals are you looking at a week, and where are the majority of them coming from?
Yeah, I'm very prejudiced right now. I'm going to be honest in that I'm very negative when I open a deal, and I'm on many mailing lists. So because I've been doing this 23 years, so
Sure.
I'm on many mailing lists, and I mean, at this point, because I'm so negative on really considering something, a lot of things I won't even open the offer manual. I'll just look at the email and say, oh, this is not going to work, and very often it's easy for me. Oh, this is a 1970s multifamily building. Wrong type of building for me. I'm looking for something 1990s or 2000 or newer, right? Or this is in this market, tertiary market. Wrong type of fit for me. This is an office building. Wrong fit for me, particularly at this particular timing until I see what happens in a recession. So because of the market timing, it's actually making my filtering even quicker than normal. What does catch my attention a little these days is either something that has a unique aspect to it, or like Layla, something I received from someone who I trust, who's already filtered it, who tell me to look at it for a specific reason. And then I will open the actual offering memorandum and start to really weed through it. But like Layla, usually there's some key things I can look at that will allow me to filter very quickly. The most easy thing right now is positive or negative leverage, and to what degree. That's the number one thing that is very easy, because almost always it does not fit my criteria right now.
Sure. And are you using AI to support you at all in your due diligence right now?
Yeah, I find it fascinating. I know she's making a run at it, and I am not at all a tech guy at all. So,
Yeah.
I am the wrong person to ask for that. That being said, I've tried using a couple of different platforms, and not for real estate, but just other things, and tested them. And what I found is that 75% of the time I'm getting the answer I want. 25% of the time I'm either getting the wrong answer to the question I didn't ask or an answer that's actually incorrect for some reason.
Yeah.
And so I've talked to people who work on AI, like actual tech programmers, well-known people. And what they told me is that they think that within 3 to 5 years, all of that will be sorted, right? So in other words, you'll have 100% confidence in the answer you're getting. The challenge I have is that if I'm only having a 75% confidence level in the answer I'm getting, then should I really be throwing this deal into AI? Because what's going to happen is in my back of my mind, I'm going to be like, it missed something. And I'm going to have to go through everything anyway. So at this point, I'm not there yet because I don't have the confidence in the tool. I think that we will get there, and I think it'll be an enormously helpful tool at some point. But I don't think we're there yet. So I'm more inclined to do it all the old school way.
Sure. Avoid the double dip there. Yeah, that's good.
Exactly.
So, Jeremy, on every one of these episodes, I ask the guest, what part of investing do you think, what part of passive investing do you think needs to die? And I'm really excited to hear yours.
The very easy answer I have is negative leverage needs to die. If you've never heard of negative leverage, you don't understand it, I strongly recommend you do some research. In normal times, investors receive positive leverage because you're getting a risk premium for the risk you're taking, and you're getting the correct return for it, okay? Negative leverage means you're getting a lower, well, I mean, it doesn't necessarily mean this, but in negative leverage, you're getting a lower return than you would normally get in a normalized time for the risk. And therefore, the price is too high. And granted, I understand that in some major value add deals, that could make sense. I don't invest in those. So if there's 1,000 ways to invest, none of them are wrong. It's whatever is the best fit for you. But in the more stabilized 80 to 90% plus occupied type of deals that I look at, if I'm getting negative leverage, it's telling me things are too expensive. And I just want all of that to go away. And there's two ways it can go away. Either prices come down or interest rates come down and we maintain the same price and we create positive leverage. It's got to be one of the two. And so I'm waiting for that to happen. I wish we could just wave a wand and it's gone.
Yeah. I was gonna say I try to stay out of the asking for predictions or asking what they think, but do you expect in the short term things to change enough where your velocity of making investments will increase to previous levels?
Well, what I would say is that real estate moves really slowly. And so it's very unlike the stock market, right? So I'd rather be a little too late than too early. And boy, did I see people take major hits in 2009 because they went in too early. And it was before they were catching a falling knife, and they unfortunately got very, very cut. And what I would say is that I do see myself getting back to normal deployment of capital once we've had a full end of cycle reset, and then maybe within, call it 2 years after that. I'm going to be very cautious within the first 2 years once that starts. But for me, once we get to 125, 150 basis points of positive leverage, if we get back there, that'll be a complete green flag for me to look at just regular market rate deals. And at that point, there's no reason for me not to invest, as long as I'm confident in the market, a type of asset, and all the other characteristics you'd be looking for.
Fantastic. Well, Jeremy, we're coming towards the end of the show. I really value the relationship I've built with you, the feedback you've given me, the encouragement you've given me. For anyone listening, if they want to get in contact with you, what's the best way to do so?
Yeah, absolutely. It's if I can help anybody anyway, happy to help. So feel free to reach out to me. Best way is my email, which is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll at rollinvestments.com.
Awesome. Jeremy, thank you so much.
No problem. Thank you for having me on. Thanks for everyone who's stuck with us here. I hope it was as helpful for all the listeners.
Yeah, great. Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.